Holy flippity flip flop flap and smokes, everyone. The Federal Reserve just saved the banks and the markets from a full-on credit freeze and liquidity crisis because things in the financial system are starting to break. After the craziness we saw in the UK financial system over the past few weeks, well, this has now come across the border to the US, but is not being talked about. So everyone, how exactly did they do this, and what is happening in the financial system that is causing things to break? Well, that's exactly what we're going to go over in today's video, so let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Okay, now first things first, something I witnessed on Friday was an absolute miracle. But you may not believe in miracles, so maybe it was more like manipulation. I was watching the futures on Friday morning, and the futures were deep in the red. And the reason for that is because the 10-year US Treasury yield was spiking uncontrollably. I saw it hit 4%, 4.1%, 4.2%, then 4.3%, and the 10-year US Treasury yield was on pace to hit 4.5%. Now, why this is so significant, people, is because bonds are absolutely crashing right now. Some bonds are nearly down 50% from their recent all-time highs. And why this is bad news for the banks and markets is because a lot of banks own these bonds and a lot of Wall Street hedge funds own these bonds. Now, what happened in the UK just a couple of weeks ago? That's right, their pension funds that were holding these 10-year government bonds in the UK, they call them gilts, well, they got margin called. And so their central bank, the Bank of England, had to come in there and save the day and bail them out. So that's right, everybody. UK pension funds did get margin calls. And also what happened in the UK financial system was there was a full-on credit freeze, specifically with lenders giving out mortgages. They absolutely cancelled all mortgage deals altogether. Look at this, house sales collapse as UK lenders withdraw mortgage offers. So again, this was the potential the US was facing if the 10-year US Treasury yield kept on spiking so rapidly. But surprise, surprise, or what some people may call a coincidence, all of a sudden there was this leaked information that there's been some infighting at the Federal Reserve. All of a sudden there were these rumors leaked to the mainstream media that the Federal Reserve was now actually debating whether or not they're going to be doing larger rate hikes after November. And what did this do, everyone? Well, that caused a speculative mania. The 10-year US Treasury yield stopped spiking and actually fell down a bit. And the DXY, the dollar, plunged, and this caused a rampant rally. And the reason why these rallies are being so violent right now is because there's so many people short. And whenever there's lots of shorts in the market or people buying lots of puts, whenever there's a rally, these people have to cover their puts or they get liquidated. So let's have a look exactly what the Federal Reserve is doing now. So listen to this, everyone. Fed officials expect debate on rate peak and when to slow hikes. Now, the reason why this is so significant is because we have investors sitting on the sidelines and they're waiting for the big famed Fed pivot. And I've been telling investors, look, be careful what you wish for, because if the Federal Reserve does pivot, it's not going to be for no reason. It's going to be because we're either in a deep recession or some kind of financial crisis like what the UK was in. US central bankers said the next phase in their campaign to curb inflation will be to debate how high to raise rates and when to slow the pace of increases. Now, people, this is absolute madness. There is no reason whatsoever for any of the Fed officials to start debating if they should start lowering rate hikes right now. If anything, they should be accelerating rate hikes. They should be giving bigger and bigger rate hikes. And you want to know why that is? Well, because unemployment, according to the government official figures, is at record lows at 3.5%. Also, we got the new CPI numbers, which was higher than expected. Excluding food and energy, the core consumer price index accelerated 0.6% and 6.6% respectively. The yearly gain for core was the highest since August 1982. And the reason why we have to pay attention to the core is because that's what the Federal Reserve pays attention to. But we all know the real inflation rate is much higher. Like with shadow stats, they say it's at least 17%. So unemployment's at record lows, inflation surging at record highs. We've got corporate earnings, it's been a mixed bag, but overall, company earnings are holding up. They haven't announced an official recession yet, even though we are in a real recession. So why should they even be talking or even thinking about slowing interest rate hikes? Remember last year, they were saying we're not even thinking about lifting rates. Well, right now, they shouldn't even be thinking about lowering rates. But again, the Federal Reserve is panicking and they're starting to bail out the banks and the Wall Street hedge funds in silent. Look at this, Swiss National Bank makes another large draw on the Federal Reserve swap lines. The Swiss National Bank this week drew nearly $6.3 billion from the US Federal Reserve currency swap line facility, roughly double the amount drawn a week earlier. The Swiss National Bank on Wednesday drew $6.27 billion in US currency for a 7-day term at an annualized rate of 3.33%. A week earlier, it drew $3.1 billion at the same term and rate. Now, people, this is very, very worrying. Central banks around the world are going bust. Just like the Reserve Bank of Australia is in negative equity, the Federal Reserve's income is in the red. They're having to pay banks more interest than revenue they're bringing in. And it's looking like the Swiss National Bank is in big, big trouble. Look, last week they had to borrow $3 billion. Now they're having to borrow $6 billion. We're seeing lots of issues with Credit Suisse. They're saying no, they're not going to go under. They're fine, just like what they said with Lehman Brothers. They're saying they'll never collapse. Well, things definitely aren't looking good, and things are looking very, very suspicious with what the Federal Reserve is meant to be doing right now. They're meant to be selling their assets, they're meant to be selling their bonds, their mortgage-backed securities, they're meant to be taking liquidity out of the system, but no, behind closed doors, they're secretly doing deals. The two transactions were larger than any of the draws the Swiss National Bank made during the spring of 2020 when it and other central banks tapped the Federal Reserve for billions of dollars during the global market panic that erupted in the early days of the pandemic. So we know how bad things were in 2020 with liquidity crisis in the money markets. Central banks had a liquidity crisis. Well, now they're withdrawing more money than they did in 2020. So what that tells me, something is not right at all. So again, the reason why the Federal Reserve is putting out these rumors now is because, like I've been warning about, people saying, when's it going to happen? Well, it is happening right now. We are in the midst of a financial crisis, but people just don't know how bad it really is yet. And another worrying sign I'm seeing with the banks, I went to the gas station today and the ATM was out of service. I wanted to get some cash out. So I went to another gas station. Again, the ATM was out of service. And a very worrying trend I'm starting to see across the nation is more and more banks are being closed, more and more branches are being closed. Some rural communities that only have one bank, that one bank is closing shop, and these people are being bankless in these towns and they're now having to travel hours to get to the nearest bank. And to this, Deutsche Bank trims investment banking staff amid slowdown. So the banks are cutting. That tells me they're in trouble. But again, going back to the speculation that the Federal Reserve is all of a sudden going to U-turn, well, this is going to backfire and backfire big, because look what's happening right now. Unrelenting inflation forces more Americans to consider getting a second job. And this is because inflation is absolutely eroding their purchasing power. That's according to a new survey which showed that 38% of workers have looked for a second job, another 14% are considering searching for another job, according to the survey of 1,000 full-time US employees. And again, the reason they're having to do this is because they're saying, look, it's great inflation because people are getting pay rises, when in real terms their wages are actually going down, adjusted for inflation. The Labor Department reported last week that the average hourly earnings for all employees declined 3% in September from the same month a year ago. So that's right, everybody. No matter how they try to push this inflation scam and why it's great for wages, what do you think's happened to the middle class standard of living over the past 3 decades? That's right. It's just gotten worse and worse and worse as they've manipulated the data more and more. The standard of living has only continued to decline. So again, let's go back to the Federal Reserve debate, because this is going to be key. You have to listen to what these central banks say, because they change their language very subtly, but they give you hints about what they're about to do. And what they do has effect on the banks, the stock market, all kinds of markets, the job market, the economy, everything. So you need to pay attention to what they're saying. St. Louis Fed President James Bullard and San Francisco Fed Chief Mary Daly both stressed the need to keep tightening policy with inflation at 40-year high while suggesting more caution next year. Well, people, do you want to know something I'm very, very worried about next year? Do you want to know why? Because right now, what the Biden administration is doing is draining the strategic petroleum reserves. This is keeping gas prices artificially low. But after the midterms and next year, they're going to have to refill these petroleum reserves, because right now they're getting to dangerous levels, which is leaving the US vulnerable right now. OPEC is cutting their production, so next year they're going to have to buy oil at a much higher price. And this is going to make gas prices skyrocket in 2023. And all these people saying that the Federal Reserve will stop at 5%, well, they're going to be in for a rude shock. The Federal Reserve is going to have to keep on hiking. Because why would you believe in that they'll stop at 4.5%? They lied when they said they won't lift interest rates till 2024. Then they lied at the start of the year. They said it would only go to 1 or 2%. Then they tried to say 3%, 4%. People, you can't listen to what the bankers say. You have to follow the data. This judgment about where you need to be to put meaningful downward pressure on inflation, I think that's a key part of the policy debate in the next two meetings. He said, citing models pointing to a 4.5 to 4.75% rate and bets in the markets of a 5% peak. So again, the Fed's saying we're only going to have to lift interest rates to 4.5%. The markets are betting they're going to go to 5%. And remember when I told people at the start of the year, rates would need to go to 5%, people called me mad. People said that will never happen. Well, the markets are now pricing this in. And people, if CPI doesn't start coming down, they're going to have to go to 6, 7, or even 8% to bring interest rates higher than the inflation rate. So they go on to say that the Federal Reserve is expected to lift interest rates by 0.75% in November and then 50 basis points in December. But everyone thinks they're only going to do one more hike in 2023, which again is wrong. So everyone, I know what you're thinking. Well, okay, what does all this economic jargon mean for you in simple terms? What this means is, everyone, we're having a bear market, classic bear market rally right now. I think when the Federal Reserve comes out and admits, no, we're going to have to keep on lifting rates higher, we're going to see the markets crash lower. If CPI data comes in hot, we're going to see the markets absolutely sell off massively. And unfortunately, I don't think the Federal Reserve is actually going to win the inflation fight. I think inflation is going to get much worse, so you're definitely going to want to prepare now. Now, how you can do this is buying the essentials you need now, because they're only going to get more expensive. Buy food, water, look at the daily essentials you need around the home. Try to get them now before they get more expensive. Second, don't even think about investing in the markets now if you have debt. Now, it may have made sense to invest before paying off debt when you could get very cheap credit with interest rates below 5%, but now interest rates are surging and they're only going to get higher. The last thing you want to do is get caught in a debt trap. So I'll be paying off debt right now if you are in debt before you start investing in the markets. Now, if you've done those two things, a great hedge throughout history has been gold and silver. We saw silver had a huge rally yesterday, up 3.8%. Yes, they haven't been performing that well lately, but they have been performing better than stocks and bonds. And what I mean by that is gold hasn't fallen as much as stocks and bonds. And what's happened throughout every single recession is when there's a huge sell-off, gold and silver get sold off along with stocks and bonds. But once we hit peak fear, once things really hit the fan, that's when we see people rush to gold and silver, like what we saw in 2020 when gold and silver had massive, massive rallies. So everyone, that was just a quick update with what's going on right now. There is so much news. That's why I'm trying to crank out more videos. What do you think about this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.